Hey everybody, welcome to, well, we were fishing and we tried to do our Facebook Live, and the intent was to do it while I was fishing, but I couldn't get my phone quite to work right to record this, so naturally here we are down in the basement. But anyway, it's very exciting. As you can see, right there's one of the tubes that we use, and the fly pulls up above it. And it's just a fun way to go out and do things. And well, we can't forget our weekly market update, because the question is, at this point, is the housing market going to crash? And even after last week, when we started talking about some of the key metrics and whatnot as to what creates an issue with the market and how do we predict a market crash. And just understand, forecasting really any kind of real estate market, forecasting any kind of economic type of outlook, hey, look, you know what, that's guessing. We can take all the best metrics that are out there, but for the most part, people are guessing, okay? And fortunately, since about 2007, when we started doing this, our guesses have been pretty much spot on, which is pretty awesome. So somebody said, George, are we going to see a crash? And here's the first thing that I have to say, and that is this, right? When demand is satisfied, it is at that point then that we will see a price reduction, all right? And until that happens, really at the end of the day, because, I have my trusty Sharpie, as you saw, when we take a look at things at the end of the day, we take a look at inventory, okay, you can see that King County has 1.86 months of inventory. And over here last year, we had 0.66. So down here on Pierce, you can see, again, 1.86 months of inventory today, and we had 0.66 months of inventory last year, which means, we had a half a month, right? Same thing here, Snohomish, 1.88 last year, 0.53 months of inventory. Okay, well, when we take a look at, hang on a second, I got it here, there we go. When we take a look at this again, and we see what does the actual number of months, we need 4 to 6 months to have a balanced market. Okay, well, that's super simple to understand. And we're at 2.1 months of inventory when we take into consideration the entire Northwest MLS. Now, that's, again, a very large area. That's half of Washington State, 2/3 of Washington State, a big area. And so we have areas that have lower inventory levels, areas that have, higher inventories, like 3 months of inventory, but those are rural areas, like out there. Okay, that's a given. When we take a look at the metropolitan areas, King, Pierce, Snohomish County, some people include Kitsap, not sure why, but anyway they do, they get numbers, when we average them out, about 2.1 months of inventory. Okay, so that means that to have a balanced market, I need to have 4 to 6 months. Okay, what does that mean? It means if I have my bucket, right, and all the agents put their listings in that bucket, boop, I put a lid on it. I should have 4 to 6 months of inventory there before we run out of inventory. That's considered a balanced market. Now, we haven't seen that really since about 2013, when we started doing the drawdown from the Great Recession, from 2008 through 2011, where the market had a massive amount of homes coming on market, and there just was not enough buyers. Interest rates were higher. To get a loan was super difficult back then, because everybody was in flux as far as what kind of loan programs, because obviously what they did during the Clinton era and what they required HUD to do to open up and allow 105, 110, 120% loan to value, so you could make a mortgage and then take all of your closing costs and put it into it. That's zero down. Those were underwater at that point, based on the fact that they figured that home values would continue to appreciate. Well, obviously that didn't happen. It cannot happen even today. That cannot happen. Didn't happen. Rip the Band-Aid off. to stop that inflation, to give again price support and stability to the housing market as a whole. Now, yes, does that mean higher interest rates? Of course it does. But then people say, well, George, look at what's going on. If things have slowed down, prices must be coming down. Down. No. In fact, not at all. In fact, funny enough, the median price is already up 6.1% for the median price of homes bought month over month. 6.1%. Okay? That's just a median price. That shows you we're still in a positive direction. We're not saying negative numbers. Heck, even when you look at condos, which, many times is not the best investment depending on, because it's more cyclical versus, a rolling upward trend with appreciation. Condos and townhomes, they tend to be more cyclical. They time themselves many times with first-time home buyers coming into a market or going out of the market, and that is going to tell us when our condo and townhome markets actually take big jumps. Okay, now even condos alone had an appreciation of 8.6% of the median price. That is an upward trend, and again, we are seeing that upward trend. And in fact, it's interesting that the Northwest MLS hasn't had a 2 months increase since 2019. More than 2 months of inventory since 2019, which is accurate. And that's just before we went into, when everybody was saying, March, April of 2020, saying, oh my gosh, the market is going to plummet, it's going to go down. And I said, no, that's not possible. Go back, watch the April, May 2020 videos that we did. They're still on our channel. Make sure you subscribe. Okay? Again, there's no selling here. This is just good metrics to make a good business decision for you and your family. Go back and look, and you'll see that we said, look, the market's not going to go down. We don't have enough inventory. You have to have inventory for something to go down. We just didn't have enough. We have twice as much inventory now. And in fact, when we take a look at these numbers here, you can see, right, here's our active year over year right here. Okay, so our year over year is up 113.9%. We doubled our inventory, which is awesome. And buyers and sellers alike are reaping the benefit. Sure. Okay, so if you're jogging, remember this analogy from last week, if you're jogging and you sprint, and then you go from a sprint down to a jog again, it doesn't mean you're going backwards. Okay? You have to understand that you're getting now back to a little bit more normal pace. Normal pace is healthy growth. Healthy growth means good investment stability. That is huge, okay? And a lot of people are like, well, I don't know, George. And I'm like, you know what? Time will tell. I understand. I said in the beginning, forecasting is basically kind of a educated guess. But we've been pretty accurate so far, all right? Now, when we come back and we take a look at new on market year over year and year to date, or month over month and year over year, new on market is doing well. Pendant, look, we're down 14%, but month over month, when we take a look at July and August of this year, and I wanted to show how much of an increase, because we're out of our vacation trifecta, one vacation trifecta, post July 4th, till about the end towards the end of August. I said we were going to see a massive bump in activity. Well, guess what? 5 weeks running. 5 weeks. 1,700, I think it's 19. Yep. Pendant sales, but new on market, 1,419. Solds are still lagging. Remember, because that's a rear view mirror. You might be saying, George, those solds, they need to be higher. They will. Next month, you're going to see, because we're seeing things that went under contract in June, July, and now we're starting to see those closing. We're going to now see next month, July, August, and you're going to see those sales go up, but you're also going to see pendants come down. You're going to see probably new on market go up, and you're going to say, what's happening? Because remember, we've got Labor Day coming up. We've got last minute vacations before October. So people's brain cells are going to be elsewhere. You have students getting back in school. It's kind of like a little mini short trifecta. Not quite like the first one, but the second one. Brain cells for buyers are elsewhere. Doesn't mean that they're gone. The pent-up demand is still there. So remember, never give me a Sharpie and a piece of paper. All right, remember, there we go. When demand is satisfied, prices will fall. Demand has not been satisfied, okay? So when we come back here and we look at this and we see the solds, again, even though we're down year over year, we are up month over month as far as trending for solds. That is going to continue in a positive trend, and that will happen up until, we're going to say, again, late August. It's going to taper off. Then in about October, boop, it's going to pick back up again until about mid-December. Normal seasonal market. It's always been that way for the 30 years that I've been practicing, and it will continue to stay that way. In fact, a lot of folks have been saying, George, what's going to happen over the next 12 to 24 months? Okay, realistically, we are going to continue to see a positive trend in our area. And in fact, there's a number of reports that are out there that even Freddie Mac and Fannie Mae are saying, we see a slowing trend, as far as volume of sale. However, we are seeing an upward trend still in market value. Not a huge, market crash, and I don't expect to see that. They're not expecting to see that, so we're aligned as far as that value. The funny thing is, when we talk about appreciation, okay, interest rates are going to hold a big picture in that, naturally, right? Probably the most, is that right? The most dominant? No, the most significant impact on the real estate market for 2022, interest rates. Hands down, interest rates. Because one, it is what changed our market in 2022. Because remember, interest rates were about where they're at today, funny enough, right? And we were just normally bobbing along. 2020, April, May, in 2020, interest rates dropped. And then you just watch things just absolutely take off. Why? Well, when you cut interest rates by 2%, people are going to go out and buy a home because it makes absolute financial sense. And they did. They dropped inventory down to horrific levels and created absolute mayhem and bedlam out there in the market. Now, the cool thing is we've got twice the inventory, so we got everything that we've asked for. Interest rates, sure, they're still bobbling in the mid to upper fives. Yep, it hit 6, but it came back down again. I think Dan Golden sent me pricing today. Par pricing today is 4.99%, which reminds me. Okay, guys, there's a video that we did, and it is evergreen, and yes, it deals with interest rates where they were at the time. The message to you is the same, and it's 5 questions you need to ask when getting quoted rate. Because let me tell you something, I have been seeing some rates, and in fact having some really interesting conversation. So this one of my clients came to me, John, and he says, George, you're not going to believe this. Look at this rate, 4.125. Look at that. That is amazing. I said, yeah. I said, what's the cost? He said, what are you talking about? I said, well, what's the cost to buy down that rate? I said, that's not par pricing today. Par pricing today is like 5%, 5.25%, 4.99. It bobbles around, with the stock market. And he's like, well, hang on a second. So he went and he got me the information. It cost 1.25. Okay, that's meaning 1.25% to buy down that rate. So if you're looking at $1 million, well, let's use $100,000 if it makes it simple for you. It'll cost you 1.25% of that to get there. If it's $1 million, you do the math. Understand, that is a cost just to get that rate. Now, if you're going to be there for 30 plus years, sure, that might make sense. I think rates are going to come down. It's going to be a lot cheaper. However, is at the end of the day, okay, make sure you look at what is the true cost of that mortgage. Sure, their purpose of marketing is to give you those rates. That's why they call it marketing, to attract you, right? Like last week, putting your home in the MLS is not marketing, okay? You need to get it out there. You pay to get it out there, but they are paying for your attention, and they got it. Why? Because that is the number that hits families the most in their pocketbook. Okay, when you take a look at the number of first-time home buyers that are out there, they have taken a significant jump, well over 30% of the market share at this point, which tells us we're transitioning again to more of a recession, which is normal. And then the first-time home buyers are also the main population that brings us out of quote-unquote a recession, and then it moves transitions into move-up buyers, where they become about 43% of the market share, and then the first-time home buyers, they actually drop down to about 32% at most of the market share of who's buying. So understand those economics and when they come in, as far as first-time home buyers come into a market, also helps to predict and let us know what our real estate market is doing. It's one of the metrics that we watch. All right, so if you have questions, if you think differently, hey, post a question, ask me a question. We love questions. And again, we normally get back to you in about 30 minutes. If it requires a little bit more depth, I shoot you a quick video. Some of you receive them and appreciate it. Some of you, it's created more questions, which is fine. There's no strings attached. We just answer them. Make sure you subscribe, okay? Because really, at the end of the day, 2022, is it going to be a seller's market? Is it going to be a buyer's market? What do you think? I've made my answer. My name was Alex Trebek. I'd have to form that in the form of a question. The answer is yes, it's going to stay to be a seller's market, and it will be probably a seller's market through next year, and only because we still have pent-up demand, we still have a lower inventory, and if people say, hey George, how can you prove a pent-up demand? Simple enough. All I have to do is go back to my running 7-day average. Look at that. We're still taking off more homes and new homes coming on market. That means that the inventory again is dropping down, and that's going to happen for a couple more weeks, and then it's going to go stale, and it will stay stale until about middle to late September. There you go. So for those of you that are trying to do a good business plan, there is your planning timeline. If you have questions, ask me. In the meantime, I'll see you guys in the next video. Let's go fly fishing. We're always looking for people to go fly fishing. In fact, we're going to head out to the Yak here in a couple of weeks. A couple of really good friends of mine. If you're interested, you should ping us. In the meantime, have an absolutely beautiful day. Take care.